Good morning everyone, my name is Mohammed Zahar, and I will be guiding you through our presentation today. Let's start by looking at the background of Parkson. Established in 1987, Parkson is a prominent department store operator headquartered in Malaysia. Over the years, Parkson has grown its footprint across Asia, with stores in Malaysia, China, Vietnam, and Indonesia. The company is renowned for offering a broad range of products, including apparel, cosmetics, household items, and more. Parkson caters to a diverse customer base, targeting mid to high-end market segments. Their business model leverages multiple revenue streams, including retail sales, consignment sales, and leasing space to other retailers. This diversified approach has helped Parkson become a key player in the retail industry across the region. Next, let's delve into the background of Padini. My name is Mohammed Zahar, and I'll continue to guide you through this presentation. Founded in 1971, Padini started as a small garment manufacturer and has since evolved into a leading fashion retailer in Malaysia. The company operates various well-known brands, including Padini, Vinci, Seed, and DD, each catering to different segments of the fashion market. Padini focuses primarily on apparel, footwear, and accessories for men, women, and children, targeting middle-income consumers with a strong presence in both physical stores and online platforms. Padini has built a reputation for offering trendy, affordable fashion. Their business model centers around specialty stores, allowing them to stay agile and responsive to changing fashion trends and consumer preferences. Padini's growth and success in the competitive fashion retail market is a testament to their effective strategies and strong brand appeal. In comparison, Padini be considered the better performing company compared to Parkson, as it demonstrates stronger liquidity and more favorable ability to cover short-term obligations. This is because Padini consistently maintains a higher ratio compared to Parkson over the 5-year period. Padini's current ratio indicates strong liquidity, a healthier balance between current assets and liabilities, providing greater confidence in its ability to meet short-term obligations. Meanwhile, Parkson's current ratio, while fluctuating, generally remains below 1, suggesting potential liquidity challenges and a higher reliance on short-term financing. In comparison, Padini is considered as the better performing company in terms of quick ratio, as it demonstrates stronger liquidity and more favorable ability to cover short-term obligations with its more liquid assets. This is because Padini consistently maintains a higher quick ratio compared to Parkson over 5-year period. Padini's quick ratio indicates a stronger ability to cover short-term liabilities with its most liquid assets, reflecting a more robust liquidity position, and Parkson's quick ratio generally remains below 1. Suggesting potential challenges in meeting short-term obligations with its most liquid assets.
Assalamualaikum and very good morning to Sir Dr. Muhammad Hafiz. My name is Muhammad HAZIQ bin Muhammad FAUZI. My registration number is 2023-424468. So today, in my part, I will present about the operating ratio, which is I will start from the average collection period. This assignment group, we choose two company, which is Padini and Parkson company. These two company we already evaluate which are the best result after we done calculating by following the formula, which is account receivable divided by sale and times 360 days. From this, we can see the result. If you can see the graph chart, which is in 2019, Padini Holding achieved a 11.67 day advantage in debt collection compared to Parkson Holding, which averaged 51.96 day. Then we move to 2020. Padini maintained its lead with a 13.06 day collection period, which is Parkson has reduced its collection time to 92 days. In 2021, Padini continued to lead with a 16.66 day collection period, whereas a Parkson collection period increased slightly to 36.99 days. If you can see in 2022, Padini collection period improved to 15.41 days, whereas a Parkson experienced a longer collection time of 59.14 days. In the last financial period, in 2023, Padini further reduced its collection period to 13.76 days, whereas the Parkson collection time is increased significantly to 69.08 days. So in conclusion, we can throughout this year, Padini Holding consistently demonstrated a better performance in average collection period compared to Parkson Holding. Next, we will move to the inventory turnover by comparing again with the Padini and Parkson company. who will appear as a good company. We can see by look at the financial year each company and the result each year by started in 2019 until 2023. As you can see the bar chart below, we can see the Parkson Holding in 2019. Parkson Holding achieved the higher inventory turnover at 11 times compared to the Padini Holding at 3.91 times. In 2020, Parkson Holding maintained a high turnover of 9.02 times, while Padini Holding improved by 2.98 times. In 2021, Padini Holding lead with the 12.55 times inventory turnover, surpassing the Parkson Holding by 2.93 times. In 2022, Parkson Holding continued to lead with a turnover of 7.56 times, while Padini Holding followed by 5.91 times. Last but not least, in 2023, Parkson Holding maintained a higher turnover of 8.72 times compared to Padini Holding, which is 2.55 times. In conclusion, throughout this year, Parkson Holding consistently demonstrated a higher inventory turnover, indicating the efficient production and sales cycles.
Hello, my name is HAZRAN bin SHAMSUDIN, and I will talk about profitability for both company. For return on asset, based on the calculated profitability ratio, Padini and Parkson have a bad return on asset throughout the year, except Parkson on 2023 have a highest return on asset, which is 3.39. Based on the table, Padini has lower below than 1% from 2019 to 2023, which is 0.17, 0.05, 0.04, 0.10, and 0.13. Same with Parkson have a lower return on asset from 2019 to 2022, which is 0.02, 0.06, 0.01, and 0.02. Padini return on asset being consistently below 1% over the past year, and is indicating a persistent struggle with asset utilization. Secondly, for net profit margin, based on profitability ratio, both companies have below 1% throughout the year, except for Parkson have marked highest net profit margins. In 2023, which is 9.27%. Padini record slightly increased than Parkson in 2019 to 2021, which is Padini has record 0.09, 0.06, 0.05, and for Parkson is 0.04 and 0.19 and 0.03. But in 2022 and 2023, Parkson has record slightly increased, which is 0.72 and 9.27, and Padini recorded 0.12% for 2022 and 2023. For return on equity, both company recorded profit below 1%, which is suggests that the company is generating minimum profit relative to shareholder equity. Padini have demonstrated a relatively stable and strong return on equity over the past year, indicating consistent profitability and effective utilization of shareholder equity. In contrast, Parkson return on equity has been more variable with mixed performance and challenges in constantly generating return for shareholder. Then for debt ratio, for leverage, we can see Padini Holding give the best result in terms of debt ratio performance rather than Parkson Holdings. A higher debt ratio indicate that larger portion of the company asset is financed by debt, which can increase financial risk and potential for defaults, especially if the company struggle to meet its debt obligation. On the other hand, the lower debt ratio suggests that the company rely less on debt financing and may have a stronger financial position. For time interest earns, both companies have their best performance until in 2023. Both company, Padini Holding, have the best ability to pay its interest compared to Parkson Holdings. A higher time interest earns ratio indicate that the company generates sufficient operating income to cover its interest expenses comfortably, suggesting a lower risk of defaults on its debt obligations. Conversely, a lower time interest earned ratio may indicate a higher risk of the default, as the company operating income may not be adequate to cover its interest payment. That for debt equity, as you can see on the table and graph, Padini Holding show the best performance in debt equity ratio rather than Parkson Holding. It is essential for company to strike a balance between debt and equity financing based on their financial goal, risk tolerance, and market condition. A prudent approach involves carefully assessing the trade-off between the benefit and risk associated with both low and high debt equity ratio to optimize the company capital structure and enhance long-term sustainability and profitability.
Hi, my name is FARID IMRAN, and I gotta explain about this slide. Conclusion. This section looks closely at the company's current financial status. Results show that Padini is an international business with a wide variety of products and an extensive geographic reach. The company's overall financial status has dramatically improved over the past 12 months. Based on Padini's most recent financial reports, a higher rate of return on investment can result from this approach. Examine the opportunities and challenges that this business is likely to encounter. Financial ratio analysis helps you assess how one company has changed over time by comparing it to another in the same industry or sector. The potential of financial ratios to assist management in analyzing their organization's financial performance for analyst and management choices has been acknowledged. Sometimes, though, it provides inaccurate financial performance and health evaluations, which is a fault. Financial ratios, however, can also be the most helpful instruments for shedding light on past occurrences and helping management and analysts of finance comprehend business trends. This ratio is still unable to produce an accurate company forecast, even though certain patterns might be able to offer a peek into a company's potential future. This study indicates that choosing any of the company's results and measurement tools is quite challenging because all of the formulas and functions are used to achieve a certain goal for the company as part of its financial strategy. Therefore, in order to use any of the methods to measure their effectiveness, the qualitative information must also comprehend the company's goals. Lastly, it can be recommended that the significance of the rationalizes be contingent to the specific demands of the stakeholders and the situation at hand. Thank you very much.